This is Channel 2 Boston. Local broadcast of Wall Street Week is made possible by grants from Interactive Data Corporation and its Active Investor Series, sophisticated software for investment research and portfolio management, designed for the individual investor. The Putnam Management Company, manager of the Putnam Mutual Funds, which are available through investment dealers and serve the full range of investor needs.
And by a grant from Bank of New England. Look to the light for complete personal money management with a cash manager account from Bank of New England. Member FDIC.
Wall Street Week with Louis Rukeyser. Brought to you by this and other public television stations. And by grants from the Hilton Hotels Corporation, America's Business Address, and Conrad International Hotels, a subsidiary of Hilton USA. Competition makes American business excel. Prudential Bache Securities, an investment firm with rock-solid resources that's leading the way to the future for investors. And the Sperry Corporation, providing high-technology, computer-based system solutions to the complex problems of business, industry, government, and national defense. Produced Friday, September 13. Our panelists are Monty Gordon, Lewis Holland, and Carter Randall. Tonight's special guest is John M. Templeton, President, the Templeton Funds.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when it was safer to be 44 million miles out in space, or 13,000 feet below sea level, than taking the greatest risk of all, staying on terra firma and buying stocks. Way out in space, a sturdy little American spacecraft flew unscathed through the tail of a comet. From deep in the North Atlantic, photographers returned with striking pictures of the great ship that went down in 1912. But in downtown New York City, Wall Street hit an iceberg, falling to pieces, as it so often unfortunately does when I take a night off from this show. The market collapsed to its lowest levels since last spring. And as for those who always maintain that it's not a stock market, it's a market of stocks, even they found that buying practically anything this week was like rearranging the deck chairs on the Titanic. The broad market took its worst weekly hit in years, with the New York Stock Exchange Composite Index, for example, showing the most damage for any week since December 5th, 1980. Now, aren't you sorry you didn't go cruising on that ocean liner with the rest of the crowd? And what caused all this devastation? Why did Wall Street wind up in a tie with Pete Rose for biggest hit of the week? No, World War III was not declared. The president seems commendably healthy. And the economic news could have been a heck of a lot worse. Retail sales, that quick indicator of the spending mood of the average citizen, actually came in much stronger than expected. Industrial production was up too, but not so swiftly as to alarm the already jittery bond market, which strengthened on the news that slow growth seemed to be the order of the day, and that producer prices were down last month and have risen only 0.8 of a percentage point in the entire last year. So neither recession nor serious inflation yet appears to be looming on the horizon. And what did ail the stock market? Our resident geniuses will, I'm sure, shortly supply the answer with their customary mythic omniscience. But the handiest explanation, meanwhile, would seem to be purely technical. If anything in Wall Street can accurately be described as pure. Investors fretted that stocks were being sold, so they sold some more. They worried that the market was dipping below alleged support levels, so they panicked and made sure it went lower. And they chewed their nails over the most theoretical question of all. Is the bull market now about to be history? Why, it's enough to send a reasonable person at least 45 million miles into space. At such moments of market hysteria, it seems especially appropriate to talk with tonight's guest, a man who has taught and practiced a philosophy of staying cool amid chaos that even Rudyard Kipling would have admired. But first, let's check out the titanic hysterics in Wall Street. And as the Dow Jones Industrial Average indicates, it was sad when that great ship went down, down, down. With volume getting heavier as the sell-off proceeded, the Dow slipped 28 points to 1307.68, a depth it hasn't touched since June 20th. And there was memorable devastation throughout the broader market indexes as well. Not enough to move our elves, though, as their technical market index remains strictly neutral. I swear there's nothing worse than a hard-hearted elf. Nor was there solace to be found in the precious metals. Amid further talk of disinflation and possible lower oil prices, gold and silver continued to erode. Even the dollar was a loser this week, and the Reagan administration capped our joy by seeking permission to raise the federal debt limit past $2 trillion. Carter Randall, is it now time to man the lifeboats?
No, I'm going to stay on this ship here, Lou. You know, it's always darkest before the dawn, and I think...
Let me jot that down.
No, I think the market is adjusting to the psychological fears of people. Mm-hmm. I think the rising trend towards protectionism in Washington raises the specter of the possibility of higher inflation. I don't think we're going to have protectionism, but it certainly puts that fear in people's minds. I think the talk about tax reform worries some investors because they don't know what form of tax changes will take place and how it will affect them. So they're hiding in the hills for a while until they see some clarity. But the real clarity here is that we still have real economic growth, that the second half will be good, and probably the first half of 1986 will be good economically and corporate earnings-wise, and that's good for the stock market.
In a nutshell, then, what's the correct investment posture here?
Correct investment posture is to hold those good quality stocks, to nibble, to accumulate, not to panic when the market goes down 1 or 2%. That's not very much. And don't worry about fluctuations.
Lou Holland, do you agree with that?
Somewhat. When I was here back in July, Lou, I expressed some concerns about the short-term and intermediate term of the market, and I had suggested at that time that I expected that we would have some correction that may carry us down the 1250 to 1300 area. That's still my position. I believe that before the end of the year we will have a meaningful rally that will carry us back up to 1400.
Well, 1250 to 1300, we're almost...
I mean 1400, I'm sorry.
Right, but I mean, you said, for the correction, you said
right.
1250 to 1300. If it's only 1300, we're almost there. If it's 1250, right. We've got a ways to go. What's your updated thought on that?
Right, our updated thought is that I believe it still will go down 1250 to 1300 before, in fact, we have a meaningful move.
Closer to 1250 or closer to 1300?
I would say closer to 1250, yeah. But I think the consensus seems to be getting more negative on the market. And I don't see how, in fact, it's likely that we'll have a correction that is deeper than that because the consensus is negative, and we've never had a severe correction when, in fact, the consensus has been negative.
I mean, everybody is so gloomy that we may get some good news before long?
I hope so.
Now, Monty Gordon, on the other hand, has been negative for so long that maybe it'll be an important indicator when he starts smiling. How do you feel about this?
Well, I think the market is responding to what I, at least, thought was some of the problems. I think some new stuff has been added in, though. I think the market and the investors are also concerned over what I would have to regard as increasing evidence of ineptitude on the part of the Congress in dealing with the problems that have begun to emerge in the economy, such as the protectionism that Carter mentioned, and a sense of disarray in the administration. I think also that the problems with the farm credit system and other things are what is additionally weighing it down. However, there is an economy out there, and it does have some strength, and it does have some potential. I think I'd put it very much the way Lou said. It's going to go down. When they finally throw in the towel, and when they finally all capitulate, and you kind of hear the end of the bulls, that'll be the time when the market probably will turn.
The whales are not quite loud enough yet.
No, they haven't yet given up.
All righty. In any event, gentlemen, it is time now to give our viewers what they deserve. Brilliant answers to penetrating questions. Carter Randall Francis McGarrigy of Falls Church, Virginia, complains that on one of the programs during my vacation, the substitute host allowed people to throw around the terms cyclical stock and defensive stocks without defining them. Knowing my own preference for the English language, he asked if I can get someone to tell him what that jargon actually means.
Well, I don't know which substitute host was being criticized here. I won't worry about that either. But let me say something very seriously, Lou. As you know, we have about 30 seconds to answer a question. And we are professionals, and we do use professional jargon. It's awfully hard to explain each and everything. However, defensive stocks means stocks that are not very volatile in the marketplace, that have high yields like utilities or bank stocks. They don't go down when the market goes down as much. And cyclical stocks are stocks of companies that are very susceptible to economic cycles, such as steels and heavy industry.
I think that's a brilliant answer, and there's no reason to be defensive about it.
No, sir.
Lou Holland, Henry Weiner of Oakland, California, says he is trying to keep up his investment income in this period of lower interest rates, and he's had his attention directed to so-called closed-end bond funds, said to yield from 11 to 12%. He'd like to know how such funds work and what the possible pitfalls might be, and he adds, these seem too good to be true.
Well, they are good yields if you compare them to the short-term yields that one gets in money market funds or treasury bills. And the closed-end bond funds or unit investment trusts are attractive. There are some advantages to the investor in that it does give him some diversification. It also provides some liquidity for him. It would give him monthly distributions of fixed income levels. The negatives relative to these funds, which are a pool of bonds, that it's a fixed portfolio, a fixed rate of return, and therefore your income comes back on a monthly basis along with some principal as in fact these bonds mature. Now you have to be careful, because if in fact you buy a long bond fund, one of the advantages is that it does fluctuate in relationship to what the market interest rate is at that point in time. But other than that, if in fact you can hold them to maturity, you know, they're a pretty good investment.
All righty. Monty Gordon, how would you respond to Pat Brown of Bloomington, Indiana, who wins tonight's I Have Absolutely No Shame Whatsoever award by writing as follows. I hear that the cutting edge of technology has now touched the making of scissors, including the introduction of ceramic blades that will stay sharp longer. Since this is a product that is found in every household, scissorhood is powerful. Perhaps there is also an opportunity here to make money. Your advice will be sheer pleasure, unquote. Pat, go straight to your room.
Well, Lou, I thought it would take a little extra effort to reply to that, so I prepared it in limerick form, which I will undertake to read. When investing in scissors, one thing keep in mind: a firm in the pink is not easy to find. Many are dull with no coupons to clip. The point is, be wary and not lose your grip. For if you're too sharp, in many a case, you can cut off your nose to spite your face. The answer is, there are companies that make scissors. They are usually very small parts of the business. Ceramic is coming in as a scissor user, but generally it doesn't offer a particular unique characteristic. But ceramics per se, outside of scissors, could be an extremely interesting area to explore for an investment.
I think I can get you a job with Burma Shave.
How do you know I was there?
Okay, now if you're tired of getting clipped in the market, let's cut through the nonsense and see if we can't make you pinking rich. Our dashing blades are here to answer your sharpest questions. At Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, who for more than 30 years has made the entire world his investment stage, let's see how he has answered that ever-changing question of where in the world to invest. His Templeton Growth Fund, begun in 1954, got off to a stellar start by catching the Canadian stock boom of the 1950s. Templeton put more than 3/4 of his fund's assets in Canadian stocks in 1955. 10 years later, it was still "Oh, Canada," though to a lesser extent, as Templeton still had 56% of his stock holdings in Canada. Canadian representation fell to just 15% by 1975, as fast-rising Japan grabbed the lion's share with 45%. And Templeton began nibbling on U.S. stocks for the first time, allocating 15% of his portfolio to American companies. But in 1980, it became Buy American, when for the first time Templeton's fund was dominated by what he considered the world's best buys, U.S. stocks. The balance of the fund's assets were allocated to Canada with 20%, Japan with 5%, the Netherlands with 4%, and Australia with 3%. Templeton was at his most fully invested then, with cash down to just 8%. The latest breakdown of this financial globetrotters fund shows its widest diversification ever. The U.S. remains the top target, though its share of the fund has shrunk to 40%. Canada is second choice with 14%, followed by Australia with 12%, an 8% Dutch concentration, and lesser amounts in 9 other nations. When it comes to investing, should we all really be more worldly? For some thoughts on that, let's go over now and meet tonight's special guest, John M. Templeton. John, welcome back. It's always a special pleasure to have you.
Thank you, Louis.
In an investment world populated all too often by transient comets, fast-talking people, fast-fading theories, and over-publicized phony balonies, John Templeton is the old man river of common sense. Not only does he stick to his precepts of seeking out global bargains and then waiting patiently for the rest of the world to recognize them, but he has compiled an astounding 30-year average rate of return approaching 15%, and at 72 runs 5 funds with assets topping $3 billion. He's tonight making his 6th appearance as my guest on Wall Street Week. John, you drew a lot of skeptical attention when you said the Dow Jones Industrial Average could hit 3,000 in this decade. Is that prediction beginning to worry you a little?
I would still say the same thing, Louis. The odds are at least 50-50 that it may reach that sometime in the next 5 years. Partly because the stocks are selling at present at low prices. Low prices in relation to yardsticks of value such as earnings, book values, replacement costs, and other things. Stocks would have to be 40% higher just to be normal today. And over the next 5 years, those values should increase by 40%.
Those figures we've just seen indicate you've cut back your American commitments by about 1/3. What does that signify?
Have we found bargains elsewhere? Every day we search worldwide to find where are the best bargains, and that determines which nations we'll invest in.
Interestingly, on the American scene, your prediction embodies a return of pretty serious inflation. A, why is that going to happen? And B, how are stocks going to do so well in that scenario?
We don't mean inflation will start right away, but looking out 5 or 10 years, we do think there'll be at least as much inflation as it was in the last 10 years, which averaged out to 8% a year. The same thing as saying the cost of living will double every 9 years. And the reasons are basically in human nature. The governments all over the world are spending too much. People are spending too much. Consumer debt is higher than ever before and rapidly increasing. And also that because we all want more money for what we produce. The farmers want more money for wheat. The steel companies want more money for steel. It's basic human nature to want inflation, although as a principle, your people are against it. We think in the next 10 years that we may have some good year with inflation as low as 2%, but at other times, inflation may get back to where it was a few years ago of 20%, averaging out to 8% per year.
Stocks did not do well in the last bout of inflation. Why would they do well in the next one?
The last period started from a high point. 17 years ago, the Dow Jones Industrial Average was about 1,000 and is now only 1,300. But if you look at the other nations of the world, almost every period of inflation has resulted in higher share prices because people put their assets into shares to protect themselves against the loss of the value of the money.
John, it's time for us to get out our globe and see where you're finding your bargains now. Where are some of the ones you're finding these days?
We're finding, particularly now in the United States, 50% of our bargains are found here.
What are some examples?
Examples in the United States would be Mid-Atlantic Banks, or FMC Corporation, or Fuquay Industries, or Jim Walter Corporation. All those are excellent, well-managed, diversified companies selling now at only 7 times present earnings, and we think they all have a good chance to double their earnings in the next 5 years.
Could you name 2 or 3 foreign stocks that you like as well?
Well, perhaps the outstanding stock is Schlumberger. Schlumberger is one of the great scientific companies spending over $100 million a year on scientific research, having only over $4 billion in cash on hand. And yet that stock is down from $87 to $35, selling at only 9 times what it'll earn next year, and will certainly double its earnings in the next 5 years. Going a further afield, Australian New Zealand Banking Corporation, or SKF Corporation, the world's largest maker of roller bearings, or Bayer Chemical, the largest chemical company in Germany. All of those would be excellent values at present, selling for less than 5 times today's earnings.
With our usual warning that even John Templeton doesn't hit a home run every time, let's turn to 3 internationally celebrated analysts, starting with Carter Randall.
Thank you, Lou. John, over and above what makes you want to buy in a given market, what do you look for in a country to decide to get out of it? Is it politics, is it economics, or is it just share prices?
It's mainly prices. When the share prices get too high, as they are now in Japan, we've reduced our holdings to almost nothing in Japan, although the outlook for the nation is still good. But we do, of course, worry about the politics. Out of over more than 160 nations in the world, there are less than 3 dozen where we would feel safe enough to invest our shareholders' money.
Thank you.
John, as you know, about 300 companies are doing business in South Africa, and that represents something like 40% of those companies in the S&P 500. And there has been a movement around the world of many institutional investors to divest their holdings in South Africa. And I just wonder what your views are, number 1, on disinvestment, and number 2, on what impact this will have on the equity markets or financial markets based on this divestiture.
I thoroughly agree with ethics in investing. I believe that every investor should carefully ask himself what are his ethics and carry that into every area of his life, including investing. To answer your specific question, we have nothing whatever invested in South African companies or bonds. We have not had for many years. But that means that it's only one of many nations where we regard the risk as too great. We can't afford to have our 300,000 shareholders invest in a place where they might lose their money. So that we do not have anything in South Africa, but we don't say that we wouldn't ever have. We do not think that the divestment, which is going on more and more rapidly by churches and others, is going to have much effect, because South Africa has now put restrictions on South Africans buying. And so if someone sells, they only sell to another foreigner. So it's only a matter of shifting your ownership from one person to another. It doesn't have any great effect on the whole world picture.
John?
Thank you. Thank you.
John, you once remarked that the time to look at your investing methods is when you're having the most success with them. And you've been through a period where you had a substantial inflation, you had one set of investments. Now, the last 3-4 years, we've had a substantial change in the overall economic scene. Have you changed any of your investment precepts in any way, or your strategy, or the way you look at a stock?
You're so right, Monty. We change all the time. Every investment method or every type of stock will eventually be too high if it becomes popular. And so we are at any given time experimenting with a wide variety of new selection methods and new concepts in order to try to stay ahead of this increasingly severe competition. So we're doing many, many things now that we didn't do in the past. But in the field of inflation, we do feel that there will be a return of inflation within 5 to 10 years, and therefore we are still concentrating in those companies that will benefit from inflation.
John, your funds have been a major beneficiary of the takeover boom. You've said that hardly a week goes by that one of the companies isn't taken over. Are you concerned in any way that the increase in mergers has ominous implications?
Yes, Louis, we think there's too much concentration. And it would be wise if they had a wider number of corporations and more competition in every nation. However, from an investor's viewpoint, where it's our duty to try to do the best we can, we do search out those companies that we think may be the subject of takeovers. And it has been a wonderfully profitable thing for the last several years.
John, while you are cautious about a resurgence of inflation, you are generally super optimistic about the future of this country. What makes you so buoyantly optimistic?
I'd like to say it's common sense, Louis. Just think, in my lifetime alone, the standard of living has quadrupled, net after inflation, quadrupled in one man's lifetime. And in my opinion, in the next 40 years, it'll quadruple again. And just going back 200 years to the time when Adam Smith wrote his book on free enterprise, The Wealth of Nations, the total output of all the world's goods and services has increased 100-fold in that time. Half the scientists who ever lived are alive today. Half of the discoveries in science have been made in this century. Half of the books ever written have been written in this century. More books are written every month than in the entire history of the earth up until the time of Columbus. In this scientific research now, this one nation alone is spending $90 billion a year on scientific research. That's more scientific research than ever existed on Earth up until the time of Adam Smith. In other areas, we are doing wonderfully great things. We should all be grateful to have lived in the most exciting, rapidly developing time of the Earth.
It's always a pleasure to talk with an optimistic young fella. Thanks very much, John Templeton. Thanks, too, to our panelists. And I hope you'll be back with us again next week when we'll turn our attention to two industries that have been making headlines all year long: tobacco and beverages. My guest, Jeffrey Weingarten, is a top analyst of both those industries, and he'll be telling us which stocks he thinks might really quench your thirst for profits once all the smoke clears. I'll drink to that. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by this and other public television stations, and by grants from the Hilton Hotels Corporation, America's business address, and Conrad International Hotels, a subsidiary of Hilton USA. Competition makes American business excel. Prudential Bates Securities, an investment firm with rock-solid resources that's leading the way to the future for investors. And the Sperry Corporation, providing high-technology computer-based system solutions to the complex problems of business, industry, government, and national defense. For a printed transcript of this program, send $2 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. That's $2 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. Maryland residents, please add 10 cents sales tax. Wall Street Week transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week is produced by Maryland Public Television, which is solely responsible for its content.
Local broadcast of Wall Street Week is made possible by grants from Interactive Data Corporation and its Active Investor Series, sophisticated software for investment research and portfolio management designed for the individual investor. The Putnam Management Company, manager of the Putnam Mutual Funds, which are available through investment dealers and serve the full range of investor needs.
And by a grant from Bank of New England. Look to the light for complete personal money management with a cash manager account from Bank of New England, member FDIC.